In what quickly became the largest Malaysian IPO in 9 years, Sunway Healthcare officially entered the public markets. The public offering raised 2.86 billion ringgit, and on its debut, the share price jumped nearly 32%. This visualization weighs the market capitalization against earnings. The market assigned Sunway a 22 billion ringgit valuation, despite a 2025 profit of just 252.2 million ringgit. That creates a massive price-to-earnings multiple. Investors pay this premium today, expecting aggressive, compounding growth tomorrow. To understand how the market justifies that premium, we have to tear down their Q4 interim financial report and look at the underlying operating leverage, rather than just the top-line revenue. The bedrock of this valuation is physical infrastructure, a sprawling, nationwide network of private hospitals. That physical footprint stems from the company's origins within the broader Sunway conglomerate, spearheaded by founder Jeffrey Chia. A 22 billion ringgit valuation depends on a highly calibrated engine of compounding unit economics and aggressive capital engineering. The financial year 2025 results show top-line revenue growing by 19%, reaching 2.2 billion ringgit. This breaks down the revenue driver equation into two levers. The first is pure volume, processing 114,425 inpatient admissions. The second, more critical lever is case intensity. Revenue per admission increased 7%, reaching 11,614 ringgit. That high-intensity billing is driven by investments in quaternary care capabilities, such as acquiring the nation's first photon-counting CT scanner for advanced diagnostics. It is also driven by complex, high-margin procedures, supported by specialized equipment that allowed surgeons to perform over 4,750 robotic-assisted surgeries. The demographic fueling these expensive procedures is shifting heavily toward medical tourism. Year over year, foreign patient revenue jumped 38%, hitting 304.7 million ringgit. That capital inflow is primarily originating from patients traveling from Indonesia, China, and Cambodia. Sunway is increasing its margins by attracting foreign wealth for highly specialized procedures, shifting its unit economics away from basic bed occupancy. But the Q4 report presents a discrepancy. If revenue and case intensity are climbing rapidly, why did core operating profit, measured as EBITDA, only grow by 9%? EBITDA stands for earnings before interest, taxes, depreciation, and amortization, and it tracks pure operational profitability. The immediate operational cause is a drop in the overall bed occupancy rate, which fell to 69% year over year. This is the result of gestation impact. Opening new, empty wings creates immediate fixed costs for staffing and maintenance before patient volumes arrive. This dual-axis chart plots bed occupancy against EBITDA. Isolating the established hospital hubs shows they are operating at a highly efficient 73% occupancy. The overall average is pulled down by newly opened greenfield sites operating at a deficit. For example, Sunway Medical Center Damansara opened in December 2024. By August 2025, it had already reached EBITDA break-even. Sunway Medical Center IPO followed a similar trajectory, opening in April 2025 and hitting its break-even point by January 2026. This rapid speed to profitability demonstrates that their hub-and-spoke operating model is highly scalable. This temporary margin drag occurred while the company aggressively expanded its total licensed beds by 27%. The slight margin compression is a controlled feature of their physical expansion. The highly profitable established hubs generate the cash required to subsidize the rapid market capture of new facilities. Moving from the income statement to the balance sheet reveals the hidden cost of expanding bed capacity by 27%. Looking at this balance sheet visualization, we see total borrowings surged by 520.4 million ringgit, pushing the total debt load to 1.59 billion ringgit in FY25. That 1.59 billion is heavily concentrated in unsecured borrowings and medium-term notes. That borrowed capital was deployed directly into physical growth, with 470.8 million ringgit allocated to capital expenditure, or CapEx, the funds a company uses to acquire and upgrade physical assets. This included major brownfield acquisitions, spending 228.5 million ringgit to purchase Tower A at SMC Velocity to capture Kuala Lumpur's dense urban market. In the northern region, they spent 60 million ringgit acquiring the Sunway Hotel Seburan Jaya, targeting it for hospital conversion and expansion. They also established a joint venture to develop a new 325-bed facility in Putrajaya, continuing their aggressive land grab strategy. Securing these properties through debt was necessary to stay on pace for their forward target of operating 2,300 beds. In the years leading up to the IPO, Sunway stretched its leverage, running its balance sheet hot to fund a massive phase of physical empire building. This context reframes the 2.86 billion ringgit IPO. It was not a founder cash-out, but a mandatory balance sheet rescue operation. This waterfall chart maps out how the IPO proceeds neutralize debt. A significant portion goes to redeeming Sukuk Wakala, Islamic bonds, immediately relieving interest pressures. The remaining public capital flows directly into the expansion pipeline. This funds the construction required to bridge the gap from their current capacity of 1,982 beds to their 2,300-bed target by the end of 2026. The IPO acted as a strategic recapitalization. It instantly deleveraged the company, allowing their hospital gestation model to scale without collapsing under debt. However, the board of directors explicitly cites several macroeconomic risks that threaten to delay that 2,300-bed timeline. Geopolitically, the ongoing Iranian conflict threatens to disrupt global medical supply chains and spike input costs for their network. Domestically, there is regulatory risk surrounding the impending transition to the DRG, or Diagnosis-Related Group, reimbursement system. The DRG system classifies hospital cases to set flat reimbursement rates. This forces hospitals to accept fixed-fee structures, which could compress the high-intensity billing margins Sunway relies on. Sunway expects to mitigate these risks through its deeply entrenched domestic market position and a highly diversified supply network. Which brings us back to the initial tension, a 22 billion ringgit valuation built on 252.2 million ringgit of profit. The 22 billion ringgit valuation represents a massive premium on a well-capitalized engine, proven to rapidly turn empty greenfield beds into high-margin profit centers.